Very good afternoon, good morning. Welcome to the HYCM online look ahead webinar with myself, Giles Cochran, a chief currency analyst. Hope everybody is doing well and looking forward to taking us through this week as we've had a tentative start for the week. The market really does have a lot to digest this week, so I'm going to be running through what those key issues are just as we're entering to the session. Don't forget, as we look at different entries, exits, the whole idea of this webinar is it's an educational perspective. It's not meant to be giving trading advice as such. So it's an educational service. So without further ado, let's get stuck into the session. So these are the key things we'll be looking at. And on Wednesday, don't forget we've got the workshop. And on the workshop, I'll be getting us ready for probably the top trading opportunity of the week, which is the Australian employment data. So we'll be looking at some key levels, particularly going to be looking at the Aussie CAD pair, which really does look interesting, as well as the Australian dollar generally, potentially for the employment data coming out midweek. So without further ado, let's get stuck in. So what we're looking at, we're going to be looking at the dollar, we're looking at the Euro-US dollar, and we'll also be looking at some of the Canadian CPI data, the German ZEW data, what's going on with Nasdaq, particularly with tech stocks and expectations of Fed rate hikes. We're looking at the pound, UK inflation data, speaking to a journalist about that this morning, as well as the Aussie and the outlook for gold. So that's the kind of the headlines we'll be looking for. So without further ado, I'm just going to go over to my other screen. I want to start by really showing you this chart. Now, this chart here is the Fed fund futures. Now, you can see that this has been moving higher because expectations for Federal Reserve interest rate hikes have been increasing exponentially over the last 2 weeks, really. Now, I was looking at some research from an investment house that saw quantitative tightening in November last year happening in 2025. Now we see quantitative tightening happening around the summer of this year. Now, Goldman Sachs came out at the beginning of last week saying that they saw the Fed potentially hiking interest rates 4 times this year. JP Morgan on Friday said they saw the Fed potentially hiking 6 or 7 times. Fed fund futures are now pricing in 4 interest rate hikes this year. So this constant expectation that the Fed's going to have to be hawkish to control rising inflation is what's been driving markets recently. Now, that you can be forgiven, and particularly if you're not following these things every day, you can be forgiven thinking, well, hang on, if the Fed is expected to raise interest rates, surely that should support the dollar. So why on earth has the dollar been moving lower? Now, you have my sympathies here. The problem is, remember the financial markets are forward-looking. So what they've been doing, they've been looking forward to the Fed making this hawkish shift since around Q4 last year. So that's why we saw the dollar being bid. Now, to start the year, we had a lot of people who were very long the dollar. We saw that the asset managers' largest long position was dollar longs. So it wasn't surprised to see some unwinding in the dollar position around the start of the year. If you remember as well, around the start of the year, there's some very particular seasonal perspectives. Now, if we just take a look here, I want to show you the dollar. You'll see that the dollar index tends to, around the start of the year, I'll just pull this nice and close to us. You see that the dollar around the start of the year, let's go over 25 years. What do you see? Well, you see that the dollar index moves lower at the end of the year and sharply higher at the beginning of the year. And that happens week in, week out, as a general rule. Now, it's not always true, but if you look 23rd of December to the 31st of December, look, 36 times the dollar's lost value. And the closer you get to the end of the month, the better that trend becomes. If you're looking at really, really tight, looking like just the last few days, it almost always dollar falls, okay? And if you take it from like 20th of December to the 31st, Do you know what I mean? That's 38 falls over that period. So it really does show you there is a predisposition. There's a taxation reason for that. Now, it's advantageous for US companies to take dollars off their books for registering their end of year company reports. Now, just as the dollar falls into year end, look, it rises quickly into start the year. So bearing that in mind, it wasn't a massive surprise to see the dollar being supported at the start of the year, right? Because you tend to see dollar bids into the start of the year, and then with those very long positions, we had that CPI print out for the US. Inflation headline was above 7%, but then it's like the market took relief. There wasn't anything further to push the dollar higher, so we saw the dollar sell off, right, into that 95 region. Key support, you can see here, resistance, 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 broken, support at 95 region. Now we have this trend line in play. 1, 2, 3, 4, that's valid trend line. We can see here if price pushes above that trend line, it's opening up a retest up to that 95.50 region. So dollar is seeing a little bit of a retracement. Now, what's the medium-term path for the dollar is uncertain. And it comes down to what expectations the Fed will do in terms of their interest rate hikes. That's what's been driving that dollar. So if the Fed seem to be more hawkish more quickly, then that should support more dollar strength. But remember, there's a lot of dollar longs in play, but actually seeing, 6 or 7 Fed rate hikes, there's even some talk about the Fed potentially surprising market with a 50 basis point rate hike in March. There's now 90% chance of a Fed rate hike in March. So the more kind of bullish sentiment we see, the more that's going to support the dollar. But we've kind of got this tension, which is dollar longs are stretched. We need to see more hawkish for the dollar to keep moving. At the moment, we've got this indecision around this trend line. So use this trend line to define and limit risk. Stay above, dollars long, get back below, dollar short. Okay, so that means risk can be nicely defined just above that outside bar, that if you do have the view that the dollar is going to continue to appreciate, then risk can be defined below this previous low just on from last Friday. Now, that dollar move lower has supported all of these major pairs higher because obviously the majors are paired with the dollar. Now, remember the euro-US dollar, this is literally the inverse of what the dollar does. So if you notice the dollar index, this is the dollar index, which we were looking at just here, overlaid on top of the euro-US dollar chart. And see, what you can see is if you inverse the dollar index, you can see, look, it's a very, very close relationship. It's due to the amount of euro weighting the dollar index has. So in other words, when the euro-US dollar falls, the dollar index rises. When the euro-US dollar rises, the dollar index falls. It's that closer relationship. So if you're trading the euro-US dollar, really what you're trading is what you think is going to happen to the dollar. So if you think the Fed is going to be even more hawkish and you're going to see dollar strength, then you'd expect this to be a false break of this 1.1450 region. And you're moving back into that resistance and support level around that 1.1400 region. Now, if you think that the dollar is going to continue to weaken, then you're looking for more upside in the euro-US dollar, and the place you would enter will be at that 1.1400, just around this near-term support. Stops can be placed nice and out the way just underneath 1.1300. So if you were looking for a move back up to 1.1600, an obvious entry will be about 1.1394, stops just the other side of 1.1300, just below that trend line, looking for a move higher. If you wanted to, you could have stops a little bit tighter, about just underneath that 1.1350 region. Now, I'm uncertain as to what the path of the dollar is going to be, but I am just pointing out that we're kind of at those crossroads, and that dollar index area is going to be important. Now, that Federal Reserve policy uncertainty has also been weighing on the bond market and on stocks. So you can see 10-year yields, they're pushing higher. Now, if you go back to 2018, what you can see is that very similarly, we saw 10-year yields pushing higher just as US growth and inflation, just as US growth was slowing. So the Fed were literally hiking into slowing growth around 2018. So 10 yields moved higher, and then they fell off sharply. So at the moment, these 10-year yields, it's a bit of a surprise to see them move higher. Now, the 2-year yields, that's not a surprise, because remember the front end of the bond curve, the 2 years, they're more sensitive to interest rate expectations. The 10-year, the further end of the curve, is more sensitive to growth and inflation expectations. So we are expecting growth and inflation to slow. So it's a surprise to see the 10-year yields rising as high as the 2-year yields are at the same time. This could easily end up being a false break of this 1.80% region. At the moment, that yield move higher is also impacting gold, and I'll come on to that in a minute. But you can see bonds yields are generally moving higher across the board. Now that pressure is being felt in the stock market. You can see here, particularly Nasdaq tech stocks, so that sharp move lower to start the year. That's because if interest rates rise at the same time that growth and inflation is slowing, that will be considered to be a policy mistake, and it means that companies are not yet ready to absorb rising interest rates. Interest rates will be rising too quickly, which would hinder growth. So that's why stocks have been moving higher. Now, also, the other thing to note is, look, stocks are at this record level higher. You see that path of acceleration from 2020? Now, this is all COVID-induced support. Look at the amount of fiscal and monetary stimulus support we've seen around the world. Central banks around the world move their interest rates to low or negative. Governments around the world released huge amounts of fiscal stimulus to support companies, individuals, and all of that has just been supporting the stock market. Now, that can't go on forever. So at some point, that support has to be withdrawn. So with the Fed raising interest rates so quickly, the concern is that they're moving it too fast. Now, don't make this mistake. Just because interest rates are rising, it doesn't mean that stocks will automatically fall. Interest rates can rise at the same time that yields are rising and stocks are moving higher. But what investors do get very scared about is if there's a disorderly move in the bond market. So you can see here, this is the VIX volatility, that's pushing lower, that's good. But if you look at the volatility here of the bond market, you can see if the bond market moves higher, that freaks investors. So you can see here that the bond market preempted that move in the VIX, and that bond market around the start of the year spiked higher because the move in bond yields was disorderly. It was fast, and it was the markets thinking that it was a policy mistake. But we saw those dips being bought. Now you can see where we're at. We're at this scenario is which narrative is correct. Is the Fed making a policy decision mistake? In which case you'd expect this level to fall. If they're not making a mistake and the market can absorb 4 interest rate hikes of 25 basis points this year, as some analysts do think they can, then this might be a decent dip to buy. The nice thing about buying a dip at this level is stops can be placed very tightly underneath that 15,131 region, because you can see that 1, 2, 3, 4, 5 key support on the Nasdaq. We also have the S&P 500 key support in the S&P 500. 1, 2, 3, 4 touches, 5 touches. Any move underneath that 4,580 would validate it. Otherwise, you could look for a move back up to 4,800. So, you know, if you do have the view that stocks will recover and that quantitative easing and the general support that's taking place, that will support stocks high. So I'll tell you what to look for. Look for company earnings. That's what markets are really focused on at the moment. How's company earnings doing? Do you see when I said the market had a lot to digest? There's a lot, isn't there? Company earnings, the Fed policy, Omicron. We haven't even started to mention Omicron. Disorderly moves in the bond market. These are some of the narratives that are going on. It's tricky. Now, also what happened, we had significant moves in the People's Bank of China taking place around yesterday. early morning this morning and late evening yesterday, depending on your time zone. Now, what the People's Bank of China did, they surprised markets at the time, but it wasn't a surprise in that they cut interest rates out of China. Now you think, well, how come China's cutting interest rates while the rest of the world is hiking interest rates? Well, it's because China's growth has been slowing down since since 2021. Growth's been slowing. Inflation is not a major concern in China right now. So while you can see those huge falls in the Chinese stock market during the course of last year, right? Now we're seeing the People's Bank of China cutting interest rates. In other words, making conditions more supportive for Chinese companies. That should be upside for the China A50. So if you're looking at going long China A50, from a medium-term perspective, I think just stops the other side of 14,200 makes sense. Okay, so just stops the other side of 14,200, looking for a move higher. Some analysts see the People's Bank of China making a further 20 basis points rate cut this year, as well as the potential for fiscal stimulus. Now, that may not happen, obviously, and we do have the tail risk of what's happening with Omicron. And some people fear that China will implement their zero free COVID policy and sort of shut down cities. But as I was sort of pointing out on my Twitter blog, they changed this perspective in China, and what they're doing now is, if you just have a look, I'll show you a decent report I saw on Bloomberg that is worth looking at. Ooh, also, I had a nice BBC appearance, so do check that out on my Twitter channel, which was a real personal highlight for me last week. Where is it? Yeah, here it is. This is really worth looking. Okay, now I'll send you the link. But I saw this, and this really got my attention, because if, oh, hang on, can you not see my chart? Oh, I hope you can see my chart now, Craig. Can everyone see my chart? Okay, I've just suddenly got worried about this. I think that should be okay. If you got any problems, please do. Yeah, okay, thanks, Richard. Oh, that's great. I was suddenly concerned that wasn't coming through. Okay, so what that means is that yes, China has got the Beijing Winter Olympics coming up, okay? So that is like a major concern for, that's a major concern for China, right? Obviously, those Beijing Olympics. But once they're out the way, right, then China can move to that approach of having like just managing dynamic management of Omicron. Now, the reports I've been reading is that Omicron is certainly milder, and this is not my opinion, this is like immunologists and virologists. Omicron is milder, has less of an impact. It tends to replicate in the throat, less in the deep lung tissue. People who are impacted less, and those who are hospitalized for shorter amounts of time, and there's a less amount of people. Generally, Omicron is something that you can see governments around the world shifting our thoughts subtly by doing things like reducing the quarantine time. France reduced restrictions between the UK and France, and you think, well, why on earth is France doing that with cases surging really high with Omicron in London, etc., etc.? Well, it's because countries are realizing that, okay, this is something I'm going to live with, and that's going from what's called a pandemic stage to an endemic stage. A pandemic stage is when you're trying to avoid transmission of the virus. An endemic stage is when you're trying to manage the transmission of the virus alongside normal economic activity. So that's the stage we're at. So once we get past those Winter Olympics, I would be shocked if we didn't see China moving in line with the rest of the world. Now, the risk to this is I haven't seen what their impact of Sinovax's. That's the Chinese vaccine. I haven't seen its efficacy impact against Omicron. Obviously, in the West, there's pretty good efficacy of the Pfizer AstraZeneca vaccines against Omicron. It's not as good as against the Delta variant, etc., but still, it's good enough. So that's what's going on. But do look at the China A50; it's worth looking at. But that's the situation with stocks. So, if the key thing to look at is corporate earnings. So going forward from here, if you start seeing corporate earnings missing earnings expectations and crucially revising earnings down, then we can see another leg lower in stocks. So the key thing here is if you are long stocks, make sure you're managing risk. So in other words, if we do see a correction down to 4,265, don't be the person that buys in at 4,700 and then is waiting through a correction as price goes down to 3,900 or 4,000. Pick your levels. So if you think stocks are going to still move higher, have your stop tight 4,566. If you get stopped out, fine, wait. Do we base around 4,300? If you start basing around 4,300, great. Put your stops just underneath 4,200. Just be nimble, be smart with your entries. No one knows the future, so we can't tell exactly what's going to happen, but we can lean against key levels and be in line with what the general projections are. Okay, so that's the best that we can do. And if you look at forecasting after about 6 months out, it becomes very hard for anyone to forecast accurately, and that's just because of life. You know what I mean? No one has a crystal ball and see the future. If people, who saw the pandemic coming specifically, no one, and no one could. You understand? It's just not possible. Yes, generally, many people were talking about the general risk of a pandemic. Sure, we've had SARS, we had bird flu, we have had warning signals, but nothing very, very definitive. So you take the view, you see the point. Okay, so what we're looking for, a couple of things. One, Bank of Japan policy rate. Now, this is a very unlikely risk, but watch out for it. Now, what the Bank of Japan is they like a weak yen, because that means, I drive a Toyota, it means that their exports are cheap. So if you have a strong currency, it means your imports are cheap and your exports are dear. So with the Bank of Japan having a weak currency, it means their exports are cheap. Weak yen, cheap exports. But what's expensive? Imports. So in other words, yes, the Bank of Japan are happy with a weak yen because it's good for the exports, but they're not so happy because it's bad for the imports. So if the yen keeps weakening, who does it squeeze? Households. So watch out that the Bank of Japan don't shift their perspective. At the moment, the last time the governor spoke, Kuroda, he said on balance, he said the level of the yen on balance is still good for the Japanese economy. In other words, he's okay. But one of his officials did come out this last week and say we need to look at the strength. We need to look at our weak yen, right? Because politically, if things are too difficult domestically, then that's pressure on politicians to do something, right? And yes, central bankers are meant to be, in the large part, separate and detached from that politicization, but everything comes down to politics in a certain extent, right? And if that's a pressure, it'll hit the central banker. Even if it's a pressure he's got to resist, it's still a pressure, right? So look out for that. So if you are expecting the yen to remain weak medium term, like I am, that's what I'm looking for, just to check there isn't a policy shift. Look at the German ZEW economic center. Don't forget, Germany is the most influential country in the eurozone in terms of its GDP and arguably politics as well, right? So if there's strong German economic sentiment, that's good for the euro. If it's weak, if there's any poor sentiment, that's further pressure on the euro potentially. So watch out for that. It should be a minor, but just note it. CPI data for the UK. Remember, the Bank of England see two things. There's a couple of things to note. So first of all, Bank of England expect inflation pressure to drop in the second half of this year. This inflation print should still be high. It shouldn't get the Bank of England's attention. There's two things that are driving inflation at the moment. One, labour. If wages rise, prices rise. So that's what inspired the Bank of England to raise interest rates by 50 basis points in December. They feared inflation becoming systemic. So essentially the fear is, oh, hang on, company owners are paying their workers more, and so their workers are paid more, so prices have to rise. Hang on, Bank of England thinks, this inflation is becoming systemic. If we're not careful, we're going to have runaway inflation. Now, we've seen the US highly criticized, as I said a number of times. I spoke to a US broadcasting house for 40 minutes on inflation. That tells you how political it is and how, much of an interesting topic it is for them. So inflation data basically not expected to be much, should be high. The best opportunity if it's a miss. So if it comes in like 4.6%, 4.5%, then expect weakness in the pound. So if you see more dollar strength, then pound US dollar downside will be a lovely trade. But if it's high or even above expectations, that's not a surprise. Everyone's expecting high inflation. Again, similarly with the Canadian dollar. Now, the Canadian dollar, they're expecting, I think, 5 or 6 interest rate hikes for the Canadian dollar, according to their interest rate probabilities. So that's very high. And what's been supporting the Canadian dollar has been this lovely run higher in oil. Okay, so as oil's moved higher, and oil has now moved up into that sort of key daily resistance level around, excuse me, there we go, around that 85, 86 region, right? Now, typically, when inflation and growth slows, oil should fall. So growth is expected to fall, inflation is expected to fall. This is not quite making sense, this rise higher in oil. But, Russia and Ukraine, that issue, that could hit oil supply. We also have Iran nuclear talks. So if they become successful, then that would be further downside in oil. But at the moment, oil is sort of supported. Now, the things that have been supporting things like the IEA have revised up higher global demand for oil in this first half of this year. Also, OPEC themselves were happy to increase production by 400,000 barrels per day at the start of the year because, they didn't see a worry in doing that. So that tells you something, they're quite happy. Also, inventory levels are low. So what I'm trying to say is there's push and pull factors on oil, but medium term, expecting oil to move lower. The only caveat to that view is if there really is inventory levels remain low and, there's a lack of investment in oil medium term because everyone's making a green pivot towards renewable energies and they forget to invest in oil, you know what I mean? And there's a risk that oil prices keep tracking higher. So my economics head is expecting this to drop lower, but I want to see some kind of key area. I haven't got the support. I don't want to be buying it into this key resistance level. Don't buy into resistance as a general rule ever. But if we see a sort of a spike higher and I see a key rejection, look at oil. But that does relate very much to what's going on with CAD. So if we see, and those charts I've been showing you as part of my role as an analyst with Financial Source, and don't forget HYCM clients can get access to that. Okay, now looking at the Canadian CPI data, if that's a big miss, if that comes in low, okay, and you can see that the last CPI, it's the core data you want to look at. That's the really interesting one. If it comes in below, say, below expectations and very shortly lower, then we would expect CAD downside. So what would be nice there is potentially US dollar CAD upside, but also look out for Aussie CAD as a pair, because you see Aussie's got this employment data. Now, employment is really important for Reserve Bank of Australia. And the reason it's important, because Reserve Bank of Australia said that they're looking at employment. It's one of the key indicators they will look at about whether they stop their quantitative easing asset program. So once you stop your QE program, then move to interest rate hikes. So in other words, if this figure is good, right, and you can see the last figure was fantastic. If this figure comes in good again, expect upside in the Australian dollar. And look at that unemployment, yeah, 4.6%. So if this comes in, it's expected to get 60. Right? Again, look at the full-time, part-time split. Full-time jobs are better than part-time. So if unemployment comes in like 4.3 and employment comes in like 120, 150,000 plus, then look for potentially Aussie CAD upside, particularly if the CAD's a miss. So the best opportunity comes from a miss in the CPI, because then that's all the pressure off the Canadian dollar. If we see oil move lower, a miss in the CAD CPI and a beat in Aussie dollar, then we could see a little shift taking place in the Aussie CAD pair, okay? And that could potentially look for nice upside in the pair moving forward. So look out for this. So the way it's potentially in, what I'm looking at, is you can go like a break of the trend line. If you see that trend line, see one of those daily points, then break of the trend line, move higher, okay? Looking on the weekly chart, if we just start to see, price move higher, move up above, and we see that, then stocks can just be under that 0.8950 region, 0.8944. If you can put your stops, always put them below a big round number, always put them below the 50s. So if you ever got a stop placement, don't put your stop at like 0.8953. Put your stop at like 0.8944, something like that, just the other side of the big round number. It's the psychological effect. So, like in a marathon, you get a cluster of finishers around the 4-hour mark, just under the 4-hour mark, because everyone's running to get under 4 hours. It's the same in the financial markets, right? People, those big round numbers are psychologically important. So Aussie CAD could be setting up. That's what I'm looking for this week. If you start getting a miss in this CAD CPI, start watching out, right? And get a beat in the Australian data. It's possible, like, if you're just thinking, I think that's going to be moving in the right direction, you can just take a punt at that. I think if I was going to take a punt, what I'd look at is maybe like, if the CAD CPI is a beat or strong and you see them move low into that 0.900 region, you could potentially buy into that spike lower if we saw any CAD strength, and then just hold the position and bring it up to like, just underneath the recent low ahead of the employment data. So I think that's one thing to look at. Gold, I'll just quickly run through what's going on with gold. Gold is tricky in one sense and very easy in another sense. So with gold, what you want to be looking for is just this very simple move. I'll show you. What's impacting gold, right, is the dollar and real yield. So I've got tips here, which is a proxy for real yields. And you see how real yields are pushing higher. Now that is nominal bond yields minus inflation expectations to get the real yields. Nominal bond yields is like, your US 10 years, right? Your US 1, 2 years. Your inflation expectations is how high inflation is expected to be. You break even 5, 10-year inflation levels, right? So at the moment, we can see that like real yields are pushing higher, but the dollar's pushing lower. Now that means gold will be pretty much sideways, okay? What you want to look for is these both moving together. So when you get real yields moving lower and the dollar moving lower, like here, December 20, you see gold moves higher. Real yields, dollar moving lower, gold moves higher, right? When you get like, hang on, real yields moving higher, dollar moving sideways, gold kind of flaps around as well. So what I want to see with gold is I want to see real yields drop lower. Now, the thing that will drop real yields lower is if you start seeing 10-year yields moving sharply lower, then watch out, because then you could see some decent upside in gold. Okay, so the sort of thing you're looking for is this. Let me just show you. See, so at the moment, yields are pushing higher, right? The 10 years, 2 years, they're pushing higher. That's putting real yields higher because bond yields are moving up higher than inflation expectations. But everyone's talking about inflation, is it peaked, yada, yada, yada. Yields are still pushing. That's pushing real yields up, which is a headwind for gold, right? If that suddenly starts tanking lower, then expect gold to surge higher at the moment with the dollar being weak. Also, one last thing I want to share with you is, don't forget risk risk positive pairs. New Zealand, we do have a medium term upside bias in New Zealand dollar yen. So like that is suitable for buying at market, stops just below 77.35. There's no guarantee, obviously, like life, that that level's going to hold, but that's looking quite robust. See New Zealand 10 years, Japanese yen 10 years pushing higher. The only risk to this is if the Bank of Japan do a little tweak to their monetary policy. If they do, then watch out, because you can see this capitulate lower. Also, if risk tone turns negative, you see yen bids, and then New Zealand dollar yen falls lower. That's what happened around the end of last year, because remember everyone was concerned about Omicron, so we saw risk off trading. So even though the outlook for the RBNZ was much more hawkish than the Bank of Japan, you can see here the bond yield spread between New Zealand 10 years, Japanese moving higher. We saw the pair move lower because of the risk off trading. Remember, when investors are scared, they buy the yen. Even when the nuclear bomb was dropped in Hiroshima and Nagasaki, the yen appreciated because of the way that debt is structured in Japan. The debt is seen as very, very reliable. So everyone's very happy to own Japanese yen in the event of a disaster. Yeah, a quick view on silver. Nikita, absolutely. Now, what you got to remember with silver, it's pushed and pulled around, very similar to gold. Okay, so again, the same pressures that I've been talking about on silver are very similar with gold. So if you just overlay a gold chart on top of this. Excuse me. Let me just that's just a little bit of a later night last night. It was nothing to do with your question, Nikita, that got me yawning at all. It was just a little bit of a late night last night. Let me just see, hang on. Okay, there we go, that's better, right. Because you see, like gold and silver track each other very similarly. What's good for the goose is good for the gander. Now they can disconnect, because sometimes silver has some industrial demand that gold doesn't. So recently, when positive risk on, and also silver's used quite a lot in solar panels and stuff, Nikita. So sometimes you get a bit of industrial demand, but generally speaking, it's the similar kind of drivers. And you can see at the moment, look, gold fell, silver fell, gold rise, silver rise, gold fell, silver fell. So with silver, it's exactly the same. And what you want to see is if you suddenly see gold surging higher and you see inflation expectations, remaining as they are, but 10-year yields dropping lower, dollar dropping lower, then the play to look at it is to look for a break of that potential upside in the silver chart. At the moment, I am neutral silver and gold, because I want to see what's happening with real yields. So for me, this is not a market just to buy and forget about. This is a market that could offer good opportunity if conditions are correct. And the conditions that are correct are as follows. I want to see the dollar moving lower at the same time as real yields are moving lower. And I'll just use tips here. That is a proxy for real yields, because real yields are only released at the end of the day, right? So that's not that helpful. But if you use that tip, it's a bond ETF. It's very similar to real yields. It tracks real yields very closely. So I use it as a proxy for real yields. I hope that helps. Nikita, does that help? So if you start to see real yields fall, dollar fall, then I expect silver upside alongside gold. And you can see like gold and silver have very strong seasonals, right? If you just look at silver around this time, usually it's very strong. The reason it's not so strong right now is just we're not seeing that, that usual demand is just not there, right? Normally you see a predisposition to buy silver, and you see a predisposition to buy gold around this time of the year. It's more often than not you see strength. Yeah, that's great, Nikita. Yeah, good. Gold and silver are markets that are potentially of interest and could very much become of interest, but not right now, is the way I'm seeing it. Okay, folks, that's the end of the session. Hope you've appreciated it. Don't forget, Season X, you can access this product to look at seasonal trades. If you become an HYCM client, you get access to that. So really, really good bonus. I hope everyone has a really good session. Don't forget, on Wednesday, I will go into detail about the Australian employment data. We'll also unpack what happened with that Canadian CPI data. So, you know, it'd be a good opportunity. And if there is a medium-term Aussie CAD opportunity, I'll run through some technicals with it as well. Folks, you have a great day, and thanks for everything as always. A particular big thank you to Richard. I know you've really helped me with someone who's been, someone was impersonating me on my Twitter account. So if you have any funny messages coming from someone who has a tag name like this at GS Coughlin CCA, they are impersonating me and trying to get people to click on malicious links, etc., etc. I have been contacting we are a supporter on it, contacting Twitter. We will get this person removed. But just remember, they're very close. So my actual Twitter handle is here, which I'm sending you in the box, so you can just see that. So thank you to Richard, who pointed that out to me. Very, very much appreciated, and Gail as well. Okay, everyone. Thanks, everyone. Now, take care, and see some folks Wednesday. Thanks now. Goodbye.